Your Highnesses, Excellencies, distinguished guests, ladies and gentlemen, good morning, Sabah al-Khair. I'd like to welcome you all to day 2 of the Energy Markets Forum under the patronage of His Highness Sheikh Hamad bin Mohammed al-Sharqi, member of the Supreme Council and ruler of Fujairah. The forum is in its 12th year, and as you will see, hopefully from some of the programs that you can find also on the Gulf Intelligence website, we're joined by really the best of the best in policy and industry today and yesterday to get down to the nitty-gritty of the question that we're going to be putting to everybody, which is how we navigate the changing winds and opportunities of the Global South and energy choke points as we look towards 2025. We had the breakfast briefings this morning, which hopefully many of you had the chance to attend, again, to tackle some of these issues such as China demand, oil benchmarks, energy flows, the changes that we've seen in those in the last 2.5 years specifically. And we're going to start shortly the plenary session, and the policy section of that we'll start with first, moving then on to the industry section a bit later in the morning. We're also going to have Energy Journalism Awards this morning. We had the pleasure last night of awarding the Aramco Trading New Silk Road CEO Awards, and today we'll be also honoring journalists in the energy space. And then we'll end the plenary session here this morning with 2 panels here on stage, one on the national UAE energy industry and another one on international energy trading. And then we'll be going up to the closed-door roundtables for the second half of the morning and coming back here for lunch to close up the forum. So packed morning for you all, and we look forward to that. So let's get started, and we're going to have a few survey questions to put to you this morning. Many of you are familiar with that format. I would like to put up the first survey now, just to sort of get our juices flowing. You should all have one of these on your seats, hopefully. And I hope we have a couple also up here for our survey panelists later on as well. So a question on price to start off with. And there we have it. What will Brent crude price average over the 3 months of the fourth quarter? We've just started the fourth quarter, of course. And there you have it. Will it be closer to 70, 75, 80, or 85? We saw the price get a bit of a blip overnight for obvious reasons. But arguably, it's been a bit lower than people have expected in the third quarter, at least, of this year. So we'll have 10 seconds on the clock and see what that gives us. (31% and 34%). Okay, so the 70 to 75 range seems to be what the majority of the room are voting for, which is, of course, where we've been in the last 3 months. And we'll get some more commentary on that also later from our panel up here. So we'll keep that survey result and show it a bit later as well as we move on. Well, we have a very special moment to really kick us off this morning. Last night, as I mentioned, we had the Aramco Trading New Silk Road CEO of the Year Awards, which recognizes individuals for their exemplary contribution to physical markets east of Suez. One category that the selection committee has the privilege of awarding each year is the Honorary Lifetime Achievement Award. And this year's accolade is given to a figure who's recognized and respected across the global energy industry. Someone who's led the UAE energy industry in the last very transformational decade, establishing the country on the international map as a sector, as a whole, as it transitions to adapt to new products, new markets, new technologies, and of course, all amidst the global climate challenge that the world is facing. The awardee also chairs several boards of directors across UAE industry, but I won't embellish his CV any more than that, but I'm delighted to announce that this year's recipient of the Aramco Trading Honorary Lifetime Achievement Award is none other than His Excellency Suhail al-Mazrou'i, the Minister of Energy and Infrastructure of the United Arab Emirates. And it's my honor now to invite His Highness Sheikh Mohammed bin Hamad bin Hamad al-Sharqi, the Crown Prince of Fujairah, and His Excellency to come up for the presentation of the award. Congratulations. Your Excellency, I'd like to now invite His Excellency to make the keynote policy speech on energy. Thank you very much and congratulations.
Your Highness, Sheikh Mohammed bin Hamad, Your Excellencies, ladies and gentlemen, first of all, it gives me great honor to receive this award, and I think this award is for the whole team, not only for me personally. So thank you very much. Today, we are gathered for the 12th time here in Fujairah at a very critical time from a geopolitical point of view, as well as from this whole industry is gathered to discuss the future. And when it comes to the future, we here in the United Arab Emirates are optimistic. We are optimistic because we have partners like you, professionals who are working for ensuring that resources are available, and from the upstream to the downstream. If we look at the past years, we learned a lot. But unfortunately, not everything that we learned or expected is happening, especially the market reaction to what happens. So we are living in a changing world. This commodity is in great need, and it would require all of us to continue working, investing and exploring, from the upstream to the midstream to downstream. If I am worried about one thing, it's the level of investment that I don't see coming to fulfill the medium to long-term requirements for the whole world. The population of the world is expanding. The demand is solid. Some are mixing the demand on renewable energy and the newer forms of energy with the demand on fossil. And I tell you, from my perspective, we need fossil to achieve to that greener target. This is exactly what we are doing here in the UAE. The highest increase when we are talking about energy is coming from renewable energy. But you ask me, is there a growth in the demand for products? And I can tell you, yes. It's in the level of 3 to 5% here in the Emirates. Number of cars are increasing, the demand on the shipping from bunkering point of view is increasing, and that's where your role comes as an enabler for this balance between the supply and demand. If we look at the producers of products, we see that that picture is changing as well. We see a decline in many countries, and without investments, and I'm not talking only about the upstream, I'm talking about the midstream refineries and trading as well, we will have a choke point. Talking about the South, the majority demand increase is going to be in the South. Many of the countries of what we call Global South have not been fortunate enough to venture into the full prosperity. We are seeing signs of that. And UAE is actually a model for that transformation. The demand is going to increase. If it's decreasing in the West because of the electrification and EVs, which is, by the way, needed for us to balance, without venturing into the electrification and EVs, we will not be able to fully supply the whole world with that growth in demand. So we need that balance, and that balance is going to make us hopefully able to supply. And I would like to recognize the role of the Emirate of Fujairah and the infrastructure they put for us, creating one of the world's major hubs for bunkering. And I can tell you that the Emirate of Fujairah is going to attain to your requirements, because we in the Emirates are thanking you for your business, and we are looking forward to serve you better. But we need not to mix, I think, the two. There is a demand, and that demand is going to increase in the future, because some of the facilities and infrastructure worldwide, refineries, are getting to the point of change. And we need to attract the investors to come and invest. People are talking about energy security, and they are forgetting the affordability. And we here in the Emirates are calling for the balance between availing the energy and ensuring it's secure, and ensuring that the customers are paying also a reasonable price for it. Therefore, this group of producers called OPEC Plus are doing a noble job, even though they are not the producers of the majority of the production of the world, but they took that responsibility to try to balance the supply and demand as much as possible, and as well encourage investments. I would like you to imagine the world without this group. We will be in chaos. Therefore, whenever I've been asked a question, some are thinking that we are perfect. We're not. We are a group of 20 diverse partners, but our aim and goal is one, which is trying to attain to that balance, sacrifice to attain to that balance. And of course, the group of 8 have put in more sacrifices than others, but that's not the critical elements. The critical element that this group is staying together. According to the global oil demand, 2023 to 2050, we are expecting a growth on the oil demand, not a decline. And especially in Asia, as I said, that growth is going to be expected to reach 50% from the levels of 2023. And that's a major investment. That would require a major investments. Gas is going to be the focus of the future, as well as we are moving to balance the renewable energy with some base load. And we will see huge requirements for gas. What we have done in the UAE, we tried our best to create a model that can be replicated for other countries. And that model started by putting an energy strategy for the long term, and then work to achieve that strategy. We put a target to tripling the capacity of renewable energy, and we are moving on that direction. Today we have 6 gigawatt of clean energy and 5.6 of renewable energy and 5.6 of clean nuclear energy. That makes the grid in UAE one of the cleanest in the region and one of the cleanest in the world, with carbon intensity of a target of 0.27 kilogram of CO2 per kilowatt. And I can tell you that the world average is north of that today. But we are very close to it, as we are going to install around 8+ gigawatt until 2030. We came up with a strategy for electrification, introducing and enabling the EVs to venture into our market and regulate it as well. And we are welcoming any technology. What I would like to leave you with is the challenges. The challenge today is, how can we, as a sector, ensure that investments are flowing and we are balancing the future demand that is coming. The adaptation of technologies is one. In my view, we need to change in order to be acceptable by our people and by the world. We need to change the way we conduct our, and we need to ensure that we are dealing with the problem of carbon. And how can we reduce it? How can we optimize in our operation to reduce emissions? That's the challenge and that's the goal. But we will stay united in addressing that goal as a country committing to this group, and as an industry as well, as ADNOC and its group of companies are doing their best to be not only among the leaders, but a leader in making sure that we are venturing into net zero with a swift and economically viable roadmap. Thank you very much, and we again appreciate your business, and we look forward to serve you better in the future. Thank you.
Your Excellency, I'm going to ask you to stay with us for 1 minute while we just look at our next survey question. So please, if you'd like to just stay at the podium 1 more minute. I would like to put up our second question, which addresses some of the points you were just making, actually, in your keynote, and perhaps get your thoughts on that, and then I'll let you go. So there's our second question. China's oil demand is moving into an era of post-growth, not post-oil. So addressing again this question of the fact that China demand may be plateauing sometime soon. So let's see if our audience agrees or disagrees with that, and if you could also vote for us. Is it moving into an era of post-growth? Agree or disagree? And we'll have 10 seconds on the clock. Okay, 70%, so the majority do agree with that. And Your Excellency, I'd like to just not necessarily ask you how you voted for this, but given that the majority of this audience, at least, and perhaps we can take that as a mark for the current sentiment, how do you think the market should be responding to the fact that there's increasing data out there that's being presented all the time, that China is nearing its point of peak oil demand sooner rather than later, perhaps than would have been expected even 6 months ago or a year ago? How do you think the market is reacting, and how should it prepare for that?
Well, first of all, I would like all of us to appreciate what China have done and is doing in terms of sustainability. China is investing heavily in all of the above, I would say. Renewable energy, expanding also on fossil, and from a demand point of view, but also in nuclear. No one is doing what China is doing today. But you will reach a stage after that where you need to balance. And I think it's very difficult to predict what China would be in 10, 20 years. There are other countries that we're not thinking of that are catching up as well. India is one, and many others. So we will see the demand in China in the future. That's, I think, is coming. What would be? Can we be 100% sure on that? I don't know. We have seen peak oil scenarios, many suggestions. Just go and read the literatures, and what they call themselves experts told us. They said 2020 would be a peak demand. They said 2022, 2025. But none of those predictions were spot on. The world is changing. I think the role of AI and electrification and other things will change the way we look at things. But my worry is not on the peak point of view. My worry is on the supply. Are we going to have enough investments to even avail what we have today? With huge infrastructure, need to be replaced, need to be vanishing. And look at how many countries 10 years ago, look at their production and their production today. So.
Okay, well, I mean, I'm glad you mentioned the supply concern, and that is definitely a medium to long-term concern. The investment going into that isn't enough. One more question to you. What about next year? What's your outlook for supply-demand balance for 2025? This year we've had arguably oversupply, short-term, subject to what's happening with demand. What's your outlook for that balance, which of course OPEC Plus is so occupied with trying to resolve?
I would refer you to the OPEC outlook because I stopped personally commenting on a short term. We give all of our information to this group, which is OPEC, and they put their best to produce that outlook that's available and anyone can look at it. That's our view. Are we going to be correct 100%? I think there are so many moving parts of the world, including geopolitics, that put us all on pause when we predict the future. So we hope for peace and we hope for prosperity, but facts of life are facts of life. Things are changing, and in the medium to long term, my worry on the outlook is the supply.
Your Excellency, thank you so much again for your time here, on your insights, and again, congratulations on your award. Please, if you'd like to take your seat. Well, we're going to continue with some more questions now, but I'm going to actually invite a panel of two gentlemen up here to join me to tackle another 2-3 questions for the Markets Forum survey. I'd like to invite Mr. Frederic Lasserre, Global Head of Research and Analysis at Gunvor, and Jorge Montepeque, Managing Director of Benchmarks at Onyx Capital Group. Thank you, gentlemen. If you'd like to take your stand there, and just we'll check your mics are working. Just give them a tap, make sure they're on. And Emma, I'm going to ask you to put up another question in a minute. But first, Jorge and Frederic, yep, working. Let's have the result, Emma, of the China demand question, please, up there. 70-30, easy numbers to remember. Jorge, your reaction to that. Tell us how you voted and how you feel about the question. Are we nearing China peak demand?
I think so. Quite clearly, I have been there and I have seen it with my own eyes. They have reached a state of development that is comparable with the West in the large cities. But very importantly is the demographics. All Northern Asia and Europe are moving to peak population. And that means less oil demand because your demand consumption peaks between 40 and 45 years old. And China is getting into that area.
Okay, and Frederic, same question to you.
Well, I guess what we've seen this year is a bit of the both. We've seen the combination of very poor economic growth in China and the very beginning of this energy transition. It's highly visible with the gasoline demand in China, which is not related specifically to growth, but much more to the EV penetration. As His Excellency made the point very clearly, it's also a desire from the Chinese authorities to move away from oil as soon as possible for many reasons, CO2 of course, but also pollution, which is a slightly different issue, and also the energy security. So if you combine this and look at the medium-term trend, we would expect Chinese demand growth to be weak. As a matter of fact, the Chinese economy is maturing, and as a result, it's less and less energy intensive or oil intensive. So this should be reflected into this post-oil trend, I would say.
Okay, thanks. And Jorge, just back to you, just because it's topical and we had this big boost of China's stimulus measures. I mean, they've been consistent, but we had a big one in the last week, moving in stock market, moving other things. Is it going to translate in any way through to general consumer oil demand, do you think, or that's separate?
By definition, the stock markets have increased between 20 and 25% in China. And that means real money in the pockets of any stockholder. In addition, they have released measures to encourage second home demand, which they had been suppressing, the government had been suppressing for a number of years. We expect this to continue to fuel the economy, but to be more evident in Q1 and Q2. So what we have here is a bad Q4 coming up for the energy business. And even if China is maturing, we mustn't forget the globality of the market. So India is your next force coming up.
Okay, as His Excellency also referred to. Okay, let's go to our next survey question, please, for the gentleman. Question number 3, there you go. What's the most likely impact of Saudi Arabia increasing oil output as planned on December the 1st? Of course, we saw a couple of announcements they were referred to last night, also in the OPEC panel here at the awards, that Saudi Arabia is intent, as it has been saying for a while, that it will be adding some oil back onto the market. So what's the most likely impact of that, should it happen? And there's the 3 choices: prolonged period of lower oil prices, stabilization of prices, perhaps now that we know what's happening, that'll stabilize things, or increase in oil prices. Not sure how that could happen, but let's see. Other factors, perhaps. So let's have 10 seconds on the clock and have everybody voting, and we'll get your views on that. So the impact of Saudi adding barrels in December, and of course through next year as well. The answer will be behind you too. So we've got 43% for a prolonged period of lower prices, 53% stabilization. That's interesting. Jorge, stabilize? Will it stabilize prices?
I'm a simple economist. More supply equals lower prices. Less supply, higher prices. So here, if we're increasing supply, it means lower prices. Please focus on what happened last night. We had a major attack of Iran against Israel, and the prices really went up by $5. Otherwise, we would be in the 60s today. The situation currently is not healthy. And we really need to look at ourselves in the mirror and say, who is oversupplying crude at the moment? And some of the answers actually reside in this neighborhood.
Okay, Frédéric, your response. Where did you vote, first of all?
Response A, I'm afraid. Yes.
Okay.
Well, I think we all know the outlook for next year. It's not very promising. Even if you take the most optimistic outlook for demand growth, which is around 1 million barrel per day plus, I would say. Non-OPEC supply alone can add 1.5. We're starting from a surplus this year. So there is clearly no room to increase supply further on top of non-OPEC supply. So if you build up the surplus, you're going to get stock built. At some point, the market will reflect that by switching from backwardation to contango, and that's opening the door for lower prices, I think.
Okay, I mean, on the second one, on 53%, Jorge, perhaps people feel confident about stability and perhaps, because, you know, if Saudi Arabia moves ahead with that, it's a signal to the rest of the group, particularly those who are overproducing at the moment, i.e. they will rein back, and that might give some confidence to the price and to the market. What about that?
No, I think if one were to take the bullish point of view, is the measures in China, the US Federal Reserve decreasing interest rates, and yes, this will create an impression of more money, and maybe inflation kicks in. If inflation kicks in, prices rise, but they are not relative to the rest. So what we need to focus on is, are the economies growing? And the economies globally right now are actually falling out of bed. China is not doing well, Germany is not doing well, France starts not to do well, so the signals are not very healthy.
Okay, the US has been doing okay, relatively speaking, but yeah, which has obviously helped matters this year, but that's beginning perhaps to shift. Let's have the next question. Okay, we're back to sort of the China question, but specifically seeing how that impacts producers. So how could weak demand growth in China impact national companies during an oil market share war? Okay, I mean, the word war is a big one. But again, the topic of market share is beginning to come back into conversations as the pressure on prices builds a little bit because of demand. So how could that weak demand, if indeed it continues, impact NOCs? Would it mean significant reduction in exports? Would it moderate reduction in exports, or have a moderate reduction, or no major impact? Frederic, I'm going to go to you to answer first. 58% have voted for the moderate
I'm the 58.
impact with the majority.
I voted for B. Yes, I would expect some only moderate reduction in exports. We do feel that Chinese runs should increase slightly next year, despite the moderate economic growth outlook. We would expect Chinese growth to be similar to this year, so slightly south of 5%. But we would expect not to see anymore some demand contraction, as we've seen probably in middle distillates, for example. So that would call for moderate reduction in crude export. However, in terms of market share war, we would not expect a big change in the market share in terms of export to China, much more like a freeze. Russia will still play a key role, and then the Middle East for the.
So there won't be any significant reduction in market share for anyone. Is the impact is magnified in the price. So if demand drops by 1%, you could have a 5% decrease in prices. And yes, Russia says one thing, but they always do the other, which is continue to produce and sell as much as they can. They need the money like anyone else.
Okay, thanks, Jorge. Let's have the next question, please. Okay. What's the most significant risk for national oil companies in an oil market share war? Again, we're looking at this sort of, as demand remains a little bit weak, how is that market share going to be impacted? And what's the most significant risk for NOCs? Is it loss of market share to non-OPEC producers? The US production is plateauing by some reports, or is it reduced profitability due to the lower prices? And will it even disrupt ongoing projects and investments of NOCs? So which of those three is the most significant risk? %, in the middle. Reduced profitability due to lower prices. Okay, Frederic, I'll go to you first on that. How did you vote?
I would agree with the 50%. Don't think that there will be a big market share redistribution among OPEC versus non-OPEC producers. It would be more like a global lower prices impacting profitability. Good to have in mind the fact that for the last few years, we had two main sources of supply which were very price sensitive. It was like OPEC on one side and the US shale on the other side. The US shale is less and less price sensitive actually because of two major drivers. One is consolidation. You see the majors entering the game, consolidating the US shale, making them less price sensitive. They're more used to be price takers. And the AI gain in productivity, which is also helping to reduce its sensitivity. So we're going to be left with only one major source of supply, which is really price sensitive in a sense.
Jorge, your response.
Yeah, there won't be any loss of market share to non-OPEC producers. In fact, there would be a gain of market share because some marginal projects would be put to bed and not see the light of the day. By definition, the profitability in the area will drop significantly. Budgets will be hit. There would be more borrowing across the Middle East, and yes, at the margin, some projects would be also cut back. So my answer is actually B and C, which of course I couldn't do.
Yeah, it's a combo. Okay, well, the next question sort of does address non-OPEC production because it's the higher cost bracket, isn't it? So let's have that put up on the screen. What impact do you think a temporary drop in oil prices has on high cost production? I mean, you know, of course, admittedly, this region has an advantage when it comes to cost of production. So, Jorge, you seem to have a different opinion that non-OPEC will not be as impacted. Let's look at those options there. It only delays development, it holds production for a short period, partial scale back of projects, significant setbacks for future projects, or it kills it off completely. Okay, that's quite an even spread there in the middle. Frederick, how did you vote?
Voted for C, only a partial scale back of projects. Again, I was just making the point before, without knowing the question, that we have less and less producers being price sensitive outside OPEC, which is on purpose, right? Even the US is less, again, price sensitive. If you look at the break-even cost for the shale, the highest break-even is around $58 WTI. So that's quite some room before we test really the pain threshold. And even at that price, not sure that we're going to see most companies closing down some project. What you do is, yes, you may delay a bit the investment, partial scale back, but they're so fast to rebound that it can be only temporary.
I mean, Jorge, the US, I mean, Frederic is saying less sensitive, but, you know, we've been hearing the argument of they're not necessarily sensitive, but they're focusing on shareholder returns, etc. No hurry to really vamp up production necessarily all the time, and they want to just stay in good profit and shareholder returns. Tell me how you answered and also address the other non-OPEC producers, if you like, not just the US. What about Brazil? What about Guyana? Higher cost producers, and how will they be impacted?
Yes, my answer was D, but I was gravitating to C as well, because it's one of the two. If prices drop, there is an impact on production, but it's the longer-term projects. So Guyana and Brazil require a lot of money, or any other country that finds oil, and it's a function of interest rates and flat price and the horizon that you have for the low price environment. At the moment, any grown-up company is looking at prices not above $75 and is looking at an interest rate that is in the 4% level, and of course they would pay 6 to 8%, and you need to work those mathematics. It's just mathematics. And the cost of some oil can assume those prices. $75 and $8, many projects will come in, but some will be hit.
Okay, and Frederic, just to wrap up for us, On that question of cost of money, obviously we've seen it begin to stabilize, perhaps come down to 4%. But what if the outlook is a 3 to 4% interest rate across the world? What impact would you say that's going to make on high-cost producers, if at all?
I'm not sure the interest rates are playing such a key role in the decision or even the timing of the project. I used to work for a big oil majors, and all the projects were assessed based on $40 assumptions to make the decision to FID the project. So you see, 40 is quite low, right? And again, it's on conventional oil project, the lead time are quite long. We're talking about 7 years on average, which means that some projects have been sanctioned 10 years ago. And now they're going to start next year, whatever the price. The investment is a sunk cost, so it's going to be price taker, whether it's 40, 50, 60, 100, doesn't make any difference in the decision to start or not the project. It's too late. You already invested billions of dollars into the project, right? So the short-term impact of interest rates, the oil price is really marginal.
Okay, well, thank you to Frédéric Dessert and Jorge Mendecueque. Thank you. A round of applause, please, gentlemen. Please take your seats. Thank you so much. Great to have your insight. Thank you so much. Well, we have another set of awards, as I mentioned earlier this morning, which are the International Energy Journalism Awards under the patronage of His Highness Sheikh Hamad bin Hamad Al Sharqi, the Crown Prince of Fujairah. And the partner for these awards is MENA Terminals. Again, I mean, like our Aramco Trading Awards, a selection committee is involved, obviously, with this process. The IAJ Awards were founded to celebrate excellence in print and broadcast reporting and journalism and communications, covering the Middle East energy sector. An 8-member international selection committee comprised of current and former energy journalists. I'm privileged to have been selected also as one of those. Is invited to submit a list of candidates for consideration in 5 categories. And then once these lists are submitted, they're collated and all together and sent back to the committee to actually review and score in order. And we culminate then with a top 3 ranking who are all invited to the awards ceremony here in Fujairah. And we also then select and declare the winner who on the top of that list. So we're delighted now to be sharing the top 3 nominees and winner of each of these categories with you. So we'll bring up the first award category on screen, please, Emma. And that's for Energy Journalism Award for Middle East Media in the Arabic language. And there are our top 3 nominees: May bin Khadra, business anchor, moderator, CNBC Arabiya; Lubna Bouza, editor-in-chief, Sky News Arabia; and Noor Ammash, business news program anchor at Asharq Business. And the winner of that, and we will again later on ask all the winners to come up in one go to receive their awards, but we'll now announce the winner of this first category is May bin Khadra, business anchor and moderator of CNBC Arabiya. Congratulations to May. The second award is for also Middle East media, but in the English language. And there are our top 3 nominees: John Benny, energy reporter at The National; Joyce Karam, editor of AI Monitor; and Joe Shidiak, CEO of JC Media Group. Those were the top 3, and the winner is John Benny, energy reporter at The National. And our third category is International Energy Journalism Awards for the International Energy Industry Specialist, Media Specialist, Herman Wang. Oh, sorry. The top 3 are Herman Wang, Associate Editor, EMEA Upstream News, S&P Global Commodity Insights; Paul Hicken, Editor-in-Chief, a Petroleum Economist; and Yasar Al-Malki, Gulf Analyst at MEES. And the winner is Herman Wang from S&P Global Commodity Insights. And I should add there were several nominees who were submitted, so these are really very good accolades to have made it into the top 3 and indeed to win it. We had a lot of fantastic nominations. The fourth award category, as you see up there, is for Energy Industry Corporate Communications Executive of the Year. Thomas Ashby, Head of Global Communications at the IEF, Ian Packham, Head of Media Relations and Thought Leadership at Siemens Energy, and Philip Robinson, Senior VP, Corporate Comms at ADNOC. And the winner is Ian Packham from Siemens Energy. And the fifth and final award is for Lifetime Achievement 2024. And I'm delighted to announce that this is a dear friend of mine and colleague, founder and CEO of eTrainer Media, Etna Trainer. Congratulations, Etna, and I'd like to now invite the award winners to please come up on stage and receive their awards one by one, and His Highness to come up and present those awards. Thank you so much. Alina, thank you so much. And May, if we can have May Khadra please up to receive her award. Your Highness. And John Benny, please. Herman Wang, please, from S&P Global. Mr. Ian Packham, please, on the comms side. And Etna Trainer. Thank you very much, Your Highness. If you'd like to take your seat. Thank you so much. And congratulations to all the journalists and communications specialists. Congratulations. Ladies and gentlemen, we're going to now move on to the industry section of the plenary. Please, tfaddalu. And thank His Highness for being with us today for the plenary session. Thank you so much to His Highness. He's now going to make his way out, and with His Excellencies. Thank you so much. Well, we're moving swiftly now to the industry section of the plenary, and to open that for us, I'm delighted to invite Mr. Ahmed bin Thalis, CEO of ADNOC Global Trading, to deliver his outlook for 2025 as the UAE emerges as a global physical energy trading hub. Thank you so much. تفضل.
Your Excellencies, esteemed guests and colleagues, it's a privilege to be here at the Fujairah Energy Market Forum. This forum highlights Fujairah's significant role in shaping global energy markets. The UAE is positioning itself to become a global physical energy trading hub by 2025, with Fujairah playing a key role as an essential part of our country's broader vision for the future of energy. Fujairah's importance cannot be overstated. Its geographic location is unrivaled. Sitting on the eastern coast of the UAE, outside the narrow Strait of Hormuz, it serves as a crucial link between the major energy markets of Asia and Europe. This positioning makes it indispensable for global energy trade. Beyond its location, storage capacity is another key element. Fujairah boasts some of the largest storage facilities in the world, allowing us to manage energy flows more effectively, respond to market demands quickly, and build resilience in times of volatility. Its deep water port and world-class infrastructure have transformed into a global refueling and logistics hub, supporting the smooth movement of energy across critical supply chains. But Fujairah's strategic value goes beyond traditional oil. It is a cornerstone of the UAE's shift towards new energy sources, whether it's sustainable aviation fuel or clean hydrogen. The UAE government direction is clear. We are embracing new energy sources and integrating them into our broader energy strategy. The entire nation is moving in lockstep towards raising the share of clean energy in our energy mix to 44% by 2050. Abu Dhabi's leading projects like green hydrogen and carbon capture. Dubai is advancing its sustainable energy infrastructure. Masdar is deriving global renewable energy projects. Fujairah is part of this broader push to ensure that energy innovation becomes the UAE's competitive advantage on the global stage. Abu Dhabi is also establishing itself as a global commodities trading hub. The Abu Dhabi Global Market and the Melbourne Future Contract are setting new benchmarks for oil trading. These initiatives highlight the UAE's leadership in global energy markets. The future of energy is not just oil, and Fujairah is playing a leading role in integrating cleaner, more sustainable energy into the nation's portfolio. This is not about replacing traditional energy, but complementing it, making Fujairah a hub where both traditional and future energy sources converge. As Fujairah role grows, so do the opportunities and the challenges. The global energy landscape is shifting. Geopolitical changes such as Europe's reorientation away from Russia Energy, are creating new dynamics. And as emerging market in the global south see their energy needs rise, Fujairah important as a connector of the markets will only increase. However, with these opportunities come challenges and risks. Risk management is not just about avoiding challenges. It's about seizing opportunities. Advances in AI and new technologies are reshaping how energy is traded, stored, and transported. At ADNOC, we aim to generate 20% of our income through AI-driven initiatives by 2025. Fujairah's ability to innovate and integrate those new technologies into its operation will determine its future competitiveness. It must not only adapt, but lead in adapting efficiencies that lower cost, reduce risks, and enhance the flow of energy through critical choke points like the Strait of Hormuz and Bab el-Mandab. The UAE is positioning itself not only as a global energy hub, but as a leader in clean energy, where oil and renewables work in tandem to meet the world's growing energy demands. However, hydrocarbons remains crucial to global energy demand. The UAE oil production set to increase to 5 million barrels per day in the near future. Fujairah is helping to balance traditional and renewable energy solutions. By 2031, the UAE could be among the top 10 hydrogen producers globally. Initiatives like Masdar Green Hydrogen Project aim to produce 1 million tons annually by 2030. Yesterday's announcement of ADNOC transformational acquisition of Conversto marks a pivotal step in our growth strategy. As a leader in high-performance polymer, Conversto strengthens ADNOC's diversification into chemicals, expanding our global footprint and enhancing our ability to meet future demand for sustainable materials. Looking ahead to 2025, the UAE's economy is poised for strong growth, driven by energy, tourism, real estate, and technology. GDP growth is projected to reach 6.2% by 2025. Our leadership vision extends beyond economic progress. It focuses on energy security, sustainability, and innovation. In conclusion, Fujairah's emergence as global physical energy trading hub is a shared achievement, a result of a strategic vision, investment, and collaboration. The Fujairah Energy Market Forum is a key platform for collaboration and discussion. The future is bright. The UAE, ADNOC, and Fujairah are ready to lead the way. Thank you very much.
Thank you very much to Mr. Bin Khalid. Well, it's time now for our MENA National Energy Leadership Panel. I'd like to invite Sean Evers, Managing Partner at Gulf Intelligence, who's going to be moderating this session and inviting his panelists up. Thanks, Sean. Over to you.
Hello.
Everybody has a mic.
Thank you very much. This session ultimately is looking at the big changes that have been happening in the national energy industry in recent times. And Ahmed just mentioned there, most notably yesterday, ADNOC acquiring the biggest ever acquisition of a Middle East company, acquiring a European industry and one of the world's most significant chemicals companies. And that is ultimately the push that's been underway for a number of years for the national energy companies to go down the value chain right through to the last dollar of the barrel, so to speak, and not to be, as in the historic position of essentially digging crude oil out of the ground, selling crude oil, halas, finish, but now it's right through the full value chain into the chemicals, the plastics, the trading, etc. And this session that with our 4 guests is looking at those changes that we've seen, most notably in the region, new trading companies, a significant increase in refining by the national energy companies of this region. So the question to kick us off before I invite up the guests, what is driving the expansion of trading activities by NOCs in the Middle East? That A, the desire to control pricing and reduce dependency on external traders, B, increased domestic demand for oil and gas products, C, the pursuit of greater flexibility in capturing value across the supply chain. The clickers are with you, 10 seconds. It's probably all of the above and maybe half a dozen other answers. But ultimately, just for a bit of fun, to put you on the spot, give us your thoughts of those 3 at least, and then we'll bring up our panelists. So 71% on C, which is where I would be, and I think that is clearly the case, and we've been told that in this setting, and I'm sure across all the countries of the region, since Sultan Al Jaber took on his leadership of ADNOC nearly 10 years ago now. It seems amazing that it is that long, but it's not quite 10, but it's certainly close to it, and it's just been totally transformational, and that has been his North Star, I would say, and that's C. So let's welcome up to the stage our 4 guests, and starting with David Bird, the CEO of OQ8. If you would come up, please, and take your position at the podium. Imad El-Kandari, the DMD International Marketing Contracts at Kuwait Petroleum Corporation. If you would take the second podium there. David, if you would take the last one. His Excellency Sheikh Ibrahim bin Khalid Al Khalifa, EVP of Business Development and International Relations at Bapco Energies. And for those of you who are aware, Bapco Energies has also recently announced its move into trading, and that is also a significant development for them. And I would also like to invite Khalid Al Ahmed, President of Ship Management at Bahri Group, if he is also here. There was some question about whether he would be able to return in time for the session. So we will kick off, and maybe he will join us. Let's start off with some opening comments by the session, the topic of the session, to give the panelists a chance to sort of give us your general overview of this change that we're talking about. And if we could start with you, Your Excellency Sheikh Ibrahim, your thoughts on this topic.
Thank you, Sean. And good morning, ladies and gentlemen. First of all, I would like to take this opportunity to thank His Highness Sheikh Mohammed bin Hamad Al Sharqi, Crown Prince of Fujairah, and the Port of Fujairah, and His Excellency Suhail Mazrou'i for their warm welcome and hospitality. It's always nice to be back in Fujairah, Sean, and thanks for the invitation.
Pleasure.
In terms of
Hopefully
your
you'll
question,
come and store some of your oil here as well, right?
why not? Why not? Fujairah, as you know, is the global hub, and it's very close proximity to Bahrain, which gives us a big advantage. Your question was to start the keynote on...
To give us your answer to the change that we're seeing. I mean, Bapco has invested, I think, in multiple billions
Yeah.
to refurbish your refinery? For what reasons? What's changing? Why have you started trading? What does that
I see.
all mean? Why is Bahrain moved? I mean, we saw Aramco do it many years ago. We saw ADNOC do it. Now Bahrain. Why?
Clear. So, as my dear colleague from Kuwait, KPC and Bahrain are the last two regional NOCs to start trading. Our colleagues in the region, be it OQ, ADNOC, Aramco, and Qatar, have started trading. I think we decided as a company to capture marginal incremental value, whereas many years we were an FOB seller. So starting trading was a strategic decision by Babco Energies to try to capture some marginal value.
So you'd agree with the answer to this question, which was C, the pursuit of greater flexibility and capturing value across the supply chain.
Absolutely. In terms of refining capacity, as you heard this morning, the demand globally, be it Asia or Africa and now Europe, is growing. The refining capacity in the region has increased. All the refineries, be it Al Zour from Kuwait or Jazan in Saudi Arabia, Ras Al Noura and Bahrain, have all expanded their refining capacity. We are targeting to address the demand going forward. These refineries are cleaner, producing cleaner products. The refineries are more cost efficient, and they're optimizing all of their resources to maximize production.
Imad, your opening thoughts. Obviously, KPC have been, for a long time, engaged down in Asia with refining and other opportunities, now into starting trading as firm in KPC, trading, setting up at the DIFC in Dubai. Your opening thoughts, please.
Well, first of all, good morning, everybody, and I appreciate allowing me to participate in this prestigious event. I extend my deepest thanks to His Highness Sheikh Hamad bin Mohammed Shargi, Supreme Council and ruler of Fujairah, for his generous patronage and unwavering support for this event. Trading. I'm very happy to announce today that KPC have passed this milestone, and I'm happy to say that we have established our trading company. It's called KPC Trading, and we managed to get office space in the IFC. We have a dedicated team currently looking after finalizing and operationalizing the company. Just to shed some light, as my colleague mentioned here.
Just as you hold the mic a little higher. Yeah,
sorry. That it is not speculation. It's all about getting more value to the barrel that is produced in Kuwait or elsewhere. Our trading company hopefully will be ready by next year, and it will be responsible for our share in the Dugum refinery, as well as some third-party barrels, either from Kuwait or from outside Kuwait.
Can I just follow up and ask you, that we've seen all of the national energy trading companies over the years, and now Aramco has offices here, the trading desk, they're in London, they're in Singapore, they're in DIFC as well. Why are you starting at the DIFC? What is it about there that seems sensible for the first step?
Well, I think it's a prime location for trading companies, and we studied many locations. I think the vicinity, it's a hub. I mean, like everybody knows, UAE is a hub, Fujairah is a hub, and it's home for all talent.
Talent is obviously key.
Absolutely. So this is one of the key things, and it's close to Kuwait as well.
And it's a lovely spot, I have to say. You know, it is a nice business park. But it's interesting that you started there as compared to, let's say, maybe starting in Kuwait or otherwise. David Bird, CEO of OQ8, the newest, grooviest refinery. you're obviously OQ, but maybe not everybody's aware, but is Oman, the sort of second energy company in Oman. Tell me about what that feels, or what your thoughts are on this change. Oman has been long one of the earliest, actually, on the trading side. Oman Trading International was co-founded with Vitol about 10 plus years ago. What does this change look like for you? Is it indeed a change? You're part of what has been a million barrels of extra refining capacity added from the region in the last year. I don't hear it on. There we go.
The on button.
The on button.
Always helps. Thank you very much for the opportunity to be here. So for those that don't know, OQ8 is our brand name. We're Duqm Refinery and Petrochemical Company, new build refinery on the east coast of Oman, facing out into the Indian Ocean. So perfect strategic location for a lot of what we're talking about.
Yeah, it's good, but it's not as good.
When it comes to demand growth, even if it's not demand growth, it's the shifting of the demand centers to these developing economies that are rapidly growing: India, East Africa, Southeast Asia. So I think the epitome of the opportunity for the region to serve these growing markets. I'm glad you raised talent. We'll talk a lot about trading. The question was why, and the response, item C, which I also responded, was to capture more value. I'd like to add one point, being an expat into this region. A lot of the commentary this morning was about the importance of supply, and I think the opportunity for the GCC to take that more medium to long-term view, now that the conversation is becoming a bit more pragmatic. It's not peak and rapidly tail off, it's peak and plateau. So if we all take the position that fossil fuels will be here for the long term, it is not just capturing value from the entire value chain, it's stepping in to retain the capability of the entire value chain. An example of that is building trading capability, investing in refining like ours, as some of the IOCs are rapidly pulling out, divesting from their refining capability. And I'm glad you raised talent, and I'll just add one. What inspires me the most coming into the region, I've been now in Oman for 2 years, is the average age. You come into our refinery and you'll see the youth. If you go to Australia, you'll find some of our schools of petroleum engineering have 0 Australian students. So some of these more developed markets, it is very hard for our industry to attract and retain the technical talent that is going to be required to sustain our supply throughout the next few decades. And I think the Middle East, the GCC countries, are really stepping in, not only to extract value from the entire value chain, but actually to build and retain the capability to serve that value chain.
Sheikh Ibrahim, I'd like to just dig a little bit into the growing refining, obviously, as David mentioned, Bapco investing multiple billions into upgrading your refinery. And the title of this session, the question, Navigating Changing East-West Winds and Market Opportunities of the Global South. Since you started the planning and executing of the refinery, things have changed. Clearly, the Global South is still the growth market, but we also now have an opening market to the west. If you might just talk a little bit about how you see the Global South opportunity for the new refineries that all of you are building and have opened.
Thank you, Sean. So the refining capacity has definitely changed, I mean, in terms of demand. Demand in Europe has increased. The fundamentals have shifted, and as you know, the Global South is growing in demand. It's solid. We're confident. We have long-standing customers, and we're building on developing more customers. Our reliable supply of products into the Global South and now Europe is growing. So
speaking of that "and now" bit,
yeah.
Do you see that as a temporary thing, or is that you didn't build your refinery or design it for that purpose, did you? Or it has emerged and you think it'll be a temporary? How do you see those market's optionality of going east or west?
I think, so for example, in Europe, the number of refineries are going offline, are growing by the day. So, refineries going offline, refining capacity increasing in the region. So that will address the demand going forward in Europe, I believe.
And from the point of view of choices, perhaps none other than Al Zour, KPC, have opened a 600,000 barrel refinery in this window of time. How has this window of time impacted the destination of those barrels, those refined products, versus what you had initially envisaged it to be?
Since Al Zour started, we had many plans before it started to target the demand centers. One of those was Europe, and this was evident. We have increased our share there to be the #1 supplier of jet fuel. In the past, we never took our gas oil to Europe.
Sorry, could somebody answer that phone that it keeps ringing?
I
Is that Jorge?
It's an alarm.
Please, on silent phones, thank you. Sorry, Imad.
Yeah, before that, we never took our diesel or gas oil to Europe. Now we are the 5th in Europe. We have started shipping LR2s to the Med and Europe, Northwest Europe. So this is a major shift for us. This is coupled with our previous project, which is the Clean Fuel Project, the CFP, which enhanced the quality of our diesel production as well as jet fuel production.
David, when we look at the sort of east-west optionality in terms of the refining markets, you had sort of articulated a number of times in your vision or in the vision of OQ8, but in the vision of all of these new refineries, that you frame it in the closing down of the Western refineries, that inevitably they're outdated, they are heavy carbon products and so forth. Does that mean that that's the market? Because obviously they have big demands for products, whereas the narrative always seems that Asia is the market for the refined products coming out of the Gulf. But Europe, with the closing of refineries there, was that a market for you? How do you see that dynamic between those two?
I think definitely the East-West dynamics will change over time. So the important thing is the strategic location of the GCC and the east coast of Oman for us particularly, in order to capitalize on those opportunities as they arise. No one would take a long-term view that there's one fixed export market. And I think yes, that was the premise, that we would build a refinery that could meet the most stringent European specs, but we were probably targeting the bulk of the volume to compete in the Asian basin. Actually, what we've discovered is that close to 50% of our products are actually competing and landing much closer to home, east coast of Africa and east-west coast of India combined. So I think a great example there of, yes, we can talk about sort of long-term global shifts, but the near-term opportunity is to build these assets that are competitive and flexible and agile to be able to serve market opportunities, because we do deal in a global commodity business.
Sheikh, the design of these refined products has been, in terms of, maybe you speak to how this is an upgrade of the Bapco refinery. You've gone way up the value chain in terms of the product mix you're looking to offer. Why are you missing out perhaps on the opportunity of the bottom of the barrel? Why have you gone so up the top end of the stream when Asia is full of refineries? India, China. Why have you chosen that mix?
So the product mix coming out of our refinery, we're a middle distillate refinery. So basically, we're doubling production of diesel going forward. With the refinery expansion, we're also doubling our jet production. We see that demand coming from Asia, is growing. We see demand from Africa growing, and we see demand in Europe picking up. So our refinery is basically a middle distillate refinery, and hopefully we grow our customer base and continue the reliable supply of products to these regions.
Imad, we've talked a bit about the change that's happening at this time that has been long planned, is happening at a time when the change of flows have brought crude and products into this region, into Africa from Europe, and the reverse. But in the context of that geopolitical shifts, how will that impact your strategies, the geopolitics of all of this that lay in the background of these new flows?
Indeed, Sean, over the last years, we've seen shifts like you mentioned. We've seen the US emerge as a supplier of crude even to the east, and LNG flows to the east as well. But our strategy is the same. We are adapting to that. We target our markets, and we have a long-term relationship with many customers. For example, in Africa, we started this relationship over a decade ago, and it's based on relationship, and we continue to do that.
I mean, historically, Kuwait has obviously had a very strong relationship in terms of Europe and America and so on. Does this moment and these changes compel to look at more aggressively at the new markets, at new long-term? I mean, Africa's growth market, the population due to double in the next 20 years. Asia obviously has its own dynamics. Are these just alternative markets, or are these strategic shifts from your point of view?
To us, to be frank, these are strategic markets, and we will continue to be there to supply our clients, our customers, for the years to come. Because as you mentioned, Africa is, there is no investment there as of yet, except for the Dangote refinery, which is a game changer. I think Africa would need more than a Dangote refinery, and it will remain market potential for big demand there.
David, could you just speak to that as well? Africa, of course, this neck of the woods, and one thinks of the global south, we think very firmly on Africa, but yet historically we haven't really had that bridge. I mean, Matt mentions the last 10 years. How do you see Africa as a destination market for all of these products, and obviously your own?
Look, I think absolutely huge. It's a huge opportunity for us. We've been pleasantly surprised by how much of our product in the near term has ended up in East Africa.
We're seeing Russian products finding a lot of homes in Africa now as well.
Absolutely. And a lot of that is driven by, look, Africa's got its challenges around governance and so forth, but still that relentless human aspiration to improve their lives, urbanization, seeking a better life, just drives that energy intensity. So we see the demand from both the population growth and the increasing urbanization will continue to drive the demand for our products. And on the flip side, because our business is supply and demand, we're a marginal business. So it's easy to only talk about demand, but as our esteemed colleagues here have said, it's about supply. We're a cyclical business. And when it comes to Africa, undoubted growing demand, but very difficult for Africa to secure investment in supply. And I don't think that's fair. I don't think that's right. But it is the reality. So I think.
Well, this could be like a refining center for Africa. Obviously, Dangote is coming. India has become a refining center for the world. Never mind just for these areas.
Absolutely.
Let's go to the next survey question before we wrap up our session, just to give everybody a chance to join in. Is the global south set to dominate global refining? Yes, due to increased refining investments in Asia and the Middle East, which we've been talking about. No, the global north will maintain dominance. C, it is unlikely as refining will become obsolete with the rise of renewables. A, B, or C, it seems like an obvious answer, but please, if you have your clickers, please vote away. 10 seconds on that. Dominate the global south. I mean, it does seem to answer itself. Your Excellency, that's clearly 70% yes, it's investing 70% there. I mean, from the point of view of market destination, when one thinks of this idea, yes, that it's going to, the global south dominate the global refining, do you think globally? I mean, obviously Europe, which is not far away through the Suez Canal and so on, but what about, like, we're talking South America, Africa, obviously we've talked about. How global do you think when you think of your market?
Very good question, Sean. Our refinery is basically catering customers, be it in, it was usually going east. Our products was the usual suspects in the east. Africa was also another customer base that we had for many, many years. Recently, we've entered Latin America. So we saw that demand coming actually as a proactive approach from us, approaching the Latin American market, and the Med with a European spec diesel has already reached Europe. So, and our jet has also reached Europe. So, be it Latin America or Africa, we have developed our customer base. We continue to develop our customer base, and we always collaborate with traders and regional players to reach those markets together.
Let's get the next survey question, please, and give the rest of our panelists a chance to close out on their comments. How do you think the increasing scale of international oil sanctions will impact the rising volumes of Gulf states' refined oil product exports? How do you think the increasing scale of international oil sanctions, increased demand for Gulf oil products due to sanctions on alternative suppliers like Russia and Iran, Venezuela. Venezuela used to be a big supplier of crude to US refiners. B, diversification of export routes and markets as Gulf states adapt to changing geopolitical dynamics. C, minimal impact as Gulf states have well-established trade relationships that can weather sanctions. How do you think the increasing scale of international oil sanctions will impact? 10 seconds on that, the rising volumes of Gulf states' refined oil products exports. Imad, your thoughts on that answer as you press A, B, or C? The results behind you, 43% saying 2. How did you vote, and what are your thoughts on that? I mean, there's a lot of sanctions now. We're seeing a lot of sort of regulatory oversight that comes with that, a lot of paperwork, a lot of concern about are you complying, who's your customer, all of these things.
Well, we're self-sanctioned, so we are following all the international, let's say, rules about sanctions. And we have our diversified market portfolio that we meet their demand.
When you see so many other countries, there's a number, as we're now most notably mentioning Russia finding new home for its products and its crude, obviously. That doesn't seem to be reducing. The countries that are sanctioned seems to grow over time. I'm wondering what opportunity do you think, that presents for your products? You've just opened a 600,000 barrel El Zour refinery and a 200,000 barrel one in Duqm.
I'll give you an example.
Yeah.
During when the Russia-Ukraine war started, at that time we had a plan to go to Europe, and it's in our plan. It's not because of the war.
Okay, it was already in the plan.
Coincided. So everybody thought that we are taking the Russians' share in the European market.
Well, the reporting was that all 600,000 capacity was going to Europe.
No, it's not. It was not working fully at that time.
All right, okay.
So, anyways, it's a plan, and we achieved that plan by grabbing those market shares that we wanted to be.
Let's go to the last question and give David the last word on this session. Right now, more than 50% of global maritime trade is at threat of disruption in 4 key choke points around the world. Has the oil market adapted with amazing flexibility, or is it asleep at the wheel? 10 seconds, adapted or asleep? And if you guys could vote on that. We saw, most notably this year, and we had some comments in our leadership roundtable by the Suez Canal Authority Director of Planning, who was telling us that their revenue is down by a half this year. The redirection of a lot of traffic around the south of Africa, which you would seem in general that it's been an amazing industry adapting putting aside the news of the day. We had 2 vessels collide in the Straits of Malacca over the summer. Your thoughts on these choke point challenges as you set up a new refinery, finding new markets? How do you see that playing out?
Oh, look, I was firmly in A.
It looks like a biased audience, I would say, but nonetheless.
But it's a bias, but it's a good, I think we should be incredibly proud of how resilient and agile our industry is. And that is borne out by the stability of the pricing, by we've had incredible dislocations on the supply side, but still the market has managed to find solutions. So I think just to echo the earlier points, it comes down to these new investments that are taken with a long-term view, and that long-term view has to have a foundation of flexibility. So an example from our own refinery, we've just loaded our second 1 million barrel cargo of diesel, and that finds its way, and actually the first one landed in France. So some of these trade dislocations like the Suez would then prohibit some of the smaller cargo size from reaching these markets competitively. So what does that mean? We need to be agile and resilient and have the infrastructure to load larger parcel sizes so that now our refined products can compete in far distant markets than might otherwise have been the case 5 or 10 years ago.
Well, we'll wrap it up there. Your challenge over coffee break, which comes after the next panel, is to find the 18% who said were asleep at the wheel and report back if you do indeed find them. Thank you to His Excellency Sheikh Ibrahim bin Khaled Al Khalifa. Thank you to David Bird, and also thank you to Imad Al Kandari of KPC. Thank you for joining us. And I hand back to our MC Diala.
Thank you very much, Sean. Well, the last panel session here in the plenary is the International Energy Trading panel. And I'd like to invite up Mr. Kieran Gallagher, Managing Director of Vitol Bahrain, Victor Katona, Head of Oil Analysis at Kipler, and Narendra Taneja, Chairman of Independent Energy Policy Institute. Gentlemen, please take the first 3 there, and we'll ignore this panel. And to moderate this session, I'm delighted to invite Tom Ashby, Head of Global Communications at the IEF. There he is, just on my right. Over to you, Tom. Thank you so much.
Thank you very much. And welcome to the panel. I think we've got a slightly curtailed timing, so we'll jump straight in. And I mean, looking now at the growth of the global south and the opportunities there are for the trading, energy trading. I mean, first question, what strategies should energy traders adopt to capitalize on the rapidly growing energy demand in the global south next year and beyond? And if I could please start with Victor Katona from Kepler, who I believe you before Kepler you were an energy trader, so you've got quite a broad kind of spectrum of experience to think about that question.
First of all, it's an absolute privilege to be here, so thank you very much. I think that basically the key trends that everyone should be looking out for is how demand is performing and how domestic capacity could saturate that demand. I think India is a very good example of a lot of refining capacity being planned, particularly 2024-25, you still have new refineries coming in, and then suddenly it stops. There's a pipeline of projected things to happen, but nothing of specificity coming into the picture. We know that India will grow. India will be by 2026, India is incrementally the largest source of demand in the world. Can domestic refining capacity satiate that? I mean, it will. Can the domestic refining capacity grow at the pace of the domestic demand? That's a good question. In 2025, it will. 26, most probably, yes. 27, 28, that's a good question. And I think these strategies where you sort of look into what's being built and how you can play around those assets would be key. Europe, again, is in a completely opposing field. Europe is shutting down 3 refineries next year, basically starting in Q1 2025. Could any of the regional players capitalize on that? Absolutely yes. So for instance, would we expect higher Middle Eastern diesel flows into Europe? Absolutely. I mean, all of the 3 refineries, Grangemouth or the German refineries that are shutting down, are middle distillate focused. That's an opportunity that could be effectively capitalized on. And I think you just need to look at the specific assets across the universe. You need to understand who's investing into future growth and how that could be met. And ultimately, if you see the discrepancy between the investments in Asia, say, and Europe, which is huge, ultimately that's the key opportunity for everyone to exploit.
Great. And Kieran, I think you're based in Bahrain for Vitol.
Correct.
How do you see the growth in the global south and the opportunities there are for traders versus, say, the more established markets in Europe?
Yes, good morning. I think, as we touched upon, and I sat in a very interesting talk for Narendra yesterday about the growth in India, but also, we've focused a lot on the growth in Africa. And Pan-Africa, we expect GDP growth to break 4% across the continent next year. So whilst there's a huge amount of cautionary tales about the north, and China, of course, dominates, ourselves and others in the sort of trading fraternity are looking at Africa. We're investing in Africa. I think, in Q2 this year, we've through our affiliate Vivo on downstream, we've acquired Engine in South Africa, and we see a similar process going on for the Shell assets in South Africa as well. And that population growth that the previous panel spoke about, the growth in the middle class there, all leads to a little bit more focus from the trading side on that. And of course, India, where we're really, India is becoming the new China in terms of the outlook, and whilst China struggles a little bit at the moment with their economy, all eyes are turning towards India and the growth story there.
Well, that's a good segue into India. And Narendra, I mean, tell us a bit from your perspective. I mean, you mentioned that India's growing its refining capacity quite significantly over the next couple of years, but there could be it could taper off after 2 or 3 years. But how do you see the opportunity in India for the global trading community?
Well, you see, India is now being recognized globally as a kind of refining power, if not superpower. And it plays a very important role in terms of, India's hard currency earnings and its place in global economics. But at the same time, we know that India can't take for granted. So there are plans to set up 2 more mega refineries, and there are suggestions that we need actually 2 more, 2 plus 2. So 2 are already kind of under work, and there is a kind of a proposal now. Of course, we have got some people who say, we don't need it, we are entering into the renewable energy age, and therefore we don't need more refineries. But I think if we take a practical view and pragmatic view, we have no alternative. 2 reasons for that. Number one, to maintain India's position as a major export hub for products. Number 3 is, of course, maybe our own domestic demand. Because the way I look at it, we are consuming today roughly 5.5 million barrels of oil per day. And my own back of the envelope calculation is that we're going to touch maybe 6.5 very soon if we sustain at 7%. But if we want to grow at 9%, probably we'll be consuming something like 7.5 million barrels a day. And if you look at the kind of ambition on the part of the people across the country, they want to grow at 9%. So, and at the same time, we know we are doing very well in terms of renewable energy, but that is not exactly the answer. We need a mix of both, renewables as well as traditional energy, including coal. So given that reality, I think, you know, we will have no option but to go for 2+2, if not 2+1, and that should help the situation. At the same time, there are proposals, you know, at the moment only proposals that Indian companies should go and invest for one mega refinery on the east coast in Africa. So that's also under discussion, which may be, if not fully, at least 51% owned by Indian interests. So there are different landscapes being talked about, but one thing is very clear, given the fact that Indian refiners, they play a very important role, India's in exports and especially the export basket. Therefore, they will get all the support they need from the federal government as well as from the state government. There are challenges like environmental lobby, renewable energy kind of push and all that. But I think when it comes to India's ambition and given the ground reality, India probably in 5 to 7 years from now, we're going to see 4 more LNG import terminals and 2 more mega refineries and hopefully maybe 2+2. Thank you.
Amazing, yeah. Well, before we jump into the second question, I thought we'd just, if we could just put the first survey to get the audience involved here a bit. And really, this is more about the context behind the trading environment, and particularly the increased Russian crude flows to Asia. The question being, has this redrawn the oil trading map? So A would be agree, it's now a permanent reality, and B, disagree, it will all return to as it was after the end of the war in Ukraine. So be interested to hear your views on that. A, agree, it's a permanent reality, and B, disagree, it'll all go back to how it was before. And I think we've got an overwhelming majority of 75% A. That's very interesting. So it's a permanent reality. I mean, perhaps it'd be interesting actually just to get your views on that, the panel. And again, maybe kick off with you, Victor. I mean, a permanent reality, because it was all cobbled together very quickly in terms of the way the market reshaped and partitioned Russian sales into new markets. But, I mean, how do you, if it is indeed a permanent reality, I mean, what are the implications for you?
Well, I voted A as well, so I think it's a permanent reality. There's several factors to it. First of all, let's assume that there's a presidential election in the United States where there's a candidate that says we're going to improve relations with Russia, it's all going to get better. Would that help? I think no, because really it's Europe that needs to lift the sanctions. Would Europe generally lift the sanctions? I think no. The answer is an absolute no. So even a change in the US policy would not necessarily trigger a change in the European policy. US was never a big buyer of Russian oil. So that's basically out of the picture in 2024-25 for sure. And then the second factor that I think is becoming increasingly important, we have had an absolutely insanely profitable couple of years over the 2022 and even 24 period. If you compare that to what 2015 or 16 or 17 felt like, it's a completely different universe. It's heaven. Now we're edging towards a period where the refinery margins are going to shrink quite massively. Now, if your refinery margins globally are shrinking, what is the key thing for your viability? Is the competitive edge. Now, why would, let's say, an Indian refiner want to continue buying Russian crude? Because it's literally $4 or $5 cheaper than anything else on the market. So India has an inherent competitive edge over everyone in basically the region. Maybe barring China, because China is the other buyer of discounted barrels globally. So effectively, everyone looks at global refinery margins or Singapore margins, you know, Middle Eastern margins or European margins, but never is the margin calculated on the basis of the Urals price. It's always calculated on the basis of Dubai prices. And if you just look at it from a perspective of the buyer, that's just locked in profits, perennial profits. Ultimately, for as long as the sanctions continue, it's an additional profit for the refiner. So I think it's mutual. The interest is mutual because for the Russians, it's a stable outlet that's not going to change. And for, say, an Indian or a Chinese refiner, that's the competitive edge that they have over the entire market.
Narendra, do you want to
Yeah.
weigh in at that point?
I think, you see, it's not permanent, or I think it's dynamic. We are entering into a completely new reality now. Reality is that since 1991, the collapse of the Soviet Union, we kind of witnessed and to some extent enjoyed a kind of one world energy order where the US played a very important role. That has gone now. That's out of the window. What we are witnessing now is the emergence or the construction of a new energy world order. And what does it mean? It means that, you know, Russia, China, Iran to some extent are going to they're building their own energy world order with its own economic fundamentals, including price. And India today is taking advantage of that. It's all economics, what India is doing, importing, you know, oil from. It's great economics. Ask Reliance Industries in India, they'll tell you. You know, they are in a very great situation. Of course, there's a political angle too. The reason India is buying oil from Russia and heavily is simply because India does not want Russia to grow too dependent on China. India wants Russia to maintain its strategic autonomy. That's a political agenda. So it's a both. It's not only economics, it's also political. And you can see that how these things are, are playing out. But that said, at the same time, my own sense is the world in terms of energy, especially oil, is now vertically split into two. One, you have the United States, part of Europe, and OECD countries, then you have China and Russia and so on. And then there are countries which are basically not neutral, but they just look at opportunities like, you know, Middle East, look at India, look at Indonesia, look at many countries in Africa and Latin America. They see just basically day to day. Okay, if I go with Russian, I get this advantage like India is doing, or should I go with the other bloc? So I think we are in a very, very different situation, very dynamic, politically very volatile. And at this stage, when we look at the horizon, we don't know how it's going to look like. Who wins in America would make a difference, but at the same time, I think we see the emergence of a new bloc. And this bloc, which is like where Russia, China are going to play an important role. Some people may want to call it BRICS bloc and whatever name. I don't think that's right. Right now, what we are witnessing is China and Russia, to some extent Iran, joining this, and this is a new bloc. And then we have the traditional bloc, which already exists. How it's going to play out is very, very difficult to say at this stage.
Yeah. I mean, turning now to Kieran, I mean, you're the kind of master of versatility to some extent, being a trader of such global proportions. But, I mean, it's very hard for us to imagine now a world that would be different than it is today. But, of course, I mean, there is, if you read the newspapers, a lot of talk about, the Ukraine conflict moving to some sort of resolution. Obviously, 2025 is round the corner, but were there to be some kind of resolution between Ukraine and Russia, could you not see the oil market then returning to some sort of previous state?
No, I think I would largely agree with my fellow panelists here. I think, you said that the map was sort of redrawn, cobbled together. I don't think it was cobbled together, actually. Markets adapt very quickly to disruption. You know, the markets are mature now. The players within the market are mature, and I've seen, COVID also was a great example of that. I think the damage is done between Russia and a lot of the European counterparts. I think relationships also get forged over time, and China and India have stepped up to take those particularly in the Russian crude. I think that those relationships get formed, and it's probably quite difficult to go back on that after. It doesn't really matter what happens with Ukraine in 2025.
Got you. Well, staying with you, Kieran, and just moving on to another question here about the rise of the Middle Eastern-owned oil trading firms, and how is that kind of, have they come to eat your lunch, or are you quite comfortable with the rise of this new demographic?
It's a good question. It does come up time and again. You know, obviously, competition is competition, and you can stand up here and make all the right noises. You know, would probably prefer there was less competition, but equally, you know, you have to. When we see the rise of Aramco Trading or AGT or Bapco Energies now, etc., like that, it's sort of, there will be that initial hit of competition for sure. But again, markets are mature. We all need trading partners. There's different ways in which, you know, instead of buying FOB from Bapco, as we have for many years, as they turn into a trading company, we supply them LNG, or you know, you become a conduit for their deliveries into Africa, or you know, we've invested in downstream. So very much, you still end up dealing with the same people. We've got, you know, other major trading houses that you would say are Vitol's main rivals. We actually trade a huge amount of volume with them on an annual basis. So yes, of course they're there to eat our lunch in a way, but again, we kind of adapt and find ways to make sure they remain trading partners.
Narendra, have you seen the rise of the Middle Eastern oil trading firms as a plus for India, for example?
No, plus is good for us and good for India, because look, the way India looks at the Middle East is more in terms of building interdependence and going for complete integration, economically and especially in the energy sector, and beyond that as well, of course, political at some stage later. And if you look at, for instance, India's push, which is getting huge traction, you know, from Western Europe and the United States and Japan and a number of other countries, there's for building a kind of economic corridor between India and the Middle East that goes from India, Middle East, right up to Europe, and is being heavily backed by the United States and a number of other G20 countries. So basically, if you look at the agenda of that economic corridor, is to basically go for complete integration, which means that, you know, the strength that the Middle Eastern countries, we call them West Asia, they have, like Saudi Arabia, United Arab Emirates, and others in the region, and what basically, you know, what we need, they can provide to us, and what they need, maybe we can provide to them, and do it in such a situation that is a win-win. So it requires, of course, you know, integration in terms of institutions, mechanisms, you know, protocols, trade protocols, tax protocols, and eventually kind of going for a situation where both India and the Middle East, the entire region, actually gets integrated in such a way that, you know, that they can build their future together. Of course, there's a political angle, if I might quickly mention that. That, of course, you know, India, the United States, and Europe somewhere are also looking at what China is doing in this part of the world in terms of BRI. So it's, some people say it's a kind of a response to BRI. That's not my view. I think if you look at the history of India and the Middle East, the history is very, very old. It's ancient. We have known the Middle East for thousands of years, and there's nothing new about us. So we know them very well, and they know us very well. In fact, 5% of the language, words that we use in our day-to-day language are Arabic words. So we know each other very well. Look at our preferences in terms of food and everything. So I think what history is going to repeat itself. We'll go for integration, and we'll kind of build an India and Middle East as a kind of very, very important economic, energy, and political power center for the world.
Yeah, and I thought it was very interesting what the earlier panel was saying about how the national companies perhaps had come to terms with the idea that trading wasn't necessarily speculation, but it was actually just you know, gaining more value across the value chain. But I mean, just turning to you, Victor, looking again at this trend of the rise of the kind of CIF players, if you like, in the Middle East, what's your perspective from the Kepler point of view?
Well, I think it was inevitable. It was inevitable to happen, but apart from the obvious fact that you need to lock in as much throughout the supply chain as you possibly could. There's also, I think, there's a human or a psychological factor which just cannot be underestimated, because effectively, if you have your own homegrown pool of talent, which is not only good in refining, not only good in storage, not only good in midstream, but is also good in optimization and trading, the amount of information that's accumulated within the same company is much higher. So effectively, in 10 years, there would be no purpose and reason for me to be in the Middle East whatsoever. There would be no one to consult or no one to tell my analysis to, because everyone would be understanding that. And because there would be a lot of proprietary trading or third-party trading happening, they would even know more than I do. The only thing that I could tell is anecdotes from my past experience, and that's it. And that is effectively the key thing for human development. Ultimately, you have a young population that would be highly competent, and at some point there would be even more than the actual domestic market needs. So you would have an outflow of Middle Eastern oil talent going everywhere. Because effectively in Europe, for instance, you look across geological departments or engineering departments specifically focusing on oil and gas. They're half empty. There's no interest. People perceive it as a bad career. Here, it's exactly the opposite. And if you know that oil is not going to disappear in 10 years, who's going to fill those spots? I mean, the answer is pretty obvious to me.
Yeah. Great. Well, just before we jump to the next question, I think we'll throw another question up on the board for the audience to have a go at. And this is the second question. Vitol, CEO, I guess that's your boss, Kieran, said last month that peak gasoline demand in China was imminent. Are global oil market stakeholders still in denial about the arrival of peak crude oil demand in China? So are the stakeholders in denial about peak crude oil demand in China? A, agree, B, disagree. Use your buzzers, please. Okay, they are in denial. That's an interesting one. Well, I guess, Kieran, you can't be in denial because your CEO was the man that said it, but give me your thoughts on that.
I will point out he was speaking about gasoline. He didn't. He
true,
didn't speak
true.
about crude. I think with regards crude, we've got to be careful here on calling for peak demand in China, because it's very nuanced. I think as Jorge Montepec said earlier, the rise of EVs, the rise of LNG-fueled trucks, etc., like that, is certainly having a huge impact on the gasoline market. And for that reason, yes, Russell pointed out that we probably see gasoline plateauing from here on in. I think there's still room for growth in the jet fuel market, you know, as again the middle classes continue to grow and new airports, etc., expansion of current airports in China. There's still a question mark over diesel. We'd probably see a little bit of growth there, maybe not so much. But with regards to peak crude as well, you know, I think where we're coming from, and a lot of analysts are coming from, is there's a plateau here on growth. It's not shrinking, right? And then we can't ignore the growth in the petchem sector. And there's some very modern technology, modern refineries in China where crude to petchems is now the thing. And we see them bringing in joint venture partners from this region as well into some of those refiners. And that growth in the petchem sector certainly points to steady demand for crude as well.
Yeah, so perhaps peak is the wrong word. In fact,
I would agree.
it's more plateau than peak. Yeah, yeah. Which actually brings with it a lot of consequences in terms of investment, for example, that would, if the plateau lasts for a long time, for example. Yeah. So we've just got a couple more minutes, I think, till we're going to close now. So just very quickly, I mean, maybe a couple of final thoughts from you, Victor and Narendra, on this question of peak crude demand in China, or more broadly, globally.
Yeah, I guess I would start. I would very much agree with Kieran. I mean, China is a nuanced story. It's reaching a peak in what we call core products, diesel, gasoline. petrochemicals and NGLs are going to increase. So effectively, we just need to focus on what specifically is growing. Will China disappoint in terms of sentiment? I think yes. Because it is a very uplifting feeling that for a decade you could grow perennially. I mean, basically there was always growth. Even in COVID years there was growth. Bam, bam, bam. Every single year you saw that demand was increasing. Now when the market is starting to realize that this is not happening, there's a sense of disappointment. Where has it gone? I think the market will increasingly start to look towards India. India will become the focus. People will start to look at consumption, real time, how people are moving, how the airplanes are flying. That's going to be everyone's effectively favorite country to look at in the sense of what could grow, because you want the growth to happen. It's difficult to live in stagnation because it bores you. There's no excitement about stagnation because, in a beautiful ballroom like this, all the spots or the places are taken. There's nothing for you if you want to join the market. Yeah. So I think China will gradually subside in terms of how much we talk about it. It's not going to subside in terms of actual demand, but the interest towards China will decrease, and India would become the new China of the 2020s, especially for the second half of this decade.
Narendra, final thoughts from you.
You see, this question of peak oil in China, I think, is premature. China is still a fossil fuel economy. When you go to Shanghai, another big city in China, you see this huge population of EVs. So it creates that illusion that China has already moved on to the next. It is not. And then also it depends how you look at it. Look at the Chinese oil companies active overseas. Look at the equity oil, as they call it. They're investing billions. Look just what they're doing in Iran, for instance, just in your neighborhood. Look in Africa. So I think, and they continue to actually invest more money in oil exploration production worldwide, securing oil. So, and moreover, if you look at their worldview, their interest in Asia, in Africa, Latin America, where oil continues to be a very, very important role as part of their foreign policy goals. So therefore, to ask this question, and you're looking only in terms of China, the geography, I think we will reach to the wrong conclusion. China is thinking of the world. And where oil is going to play a very, very important role. Oil is a very important part of the global energy diplomacy. So that's how we should look at it. So this question, whether peak oil in China is premature, to some extent irrelevant.
Great. Well, thank you very much, Narendra, Victor, and Kiran, for your thoughts. And I think we're going to wrap it up there. A round of applause for the panel. And I'll hand it back to Ella.
So much, Tom. Thank you, gentlemen. I have to say that was an excellent panel, really interesting dynamics of the market, and I like to see some disagreement up here on stage as well. That keeps it active. Well, that brings us to the end of this plenary session, and the next step is we're going to all move upstairs to the round tables, which will be on the mezzanine level. Coffee will be served there, sponsored and hosted by MENA Terminals. Who will also be hosting us actually for lunch back here at 1 p.m. after the round table sessions. And for those of you who've registered for the 2:30 p.m. Fujairah Port boat tour, that will be leaving at 2:30 from the main lobby of the hotel after lunch. So thank you everyone so much for attending, and off we go upstairs to the mezzanine level for the round tables, and safe journey homes later on. Thank you so much. So just to repeat, coffee break upstairs through the lobby and up to the mezzanine level for coffee by MENA Terminals, where the round tables will also be taking place. Mezzanine level coffee will be served. Thank you, everyone.